Hello friends, this is CS Sandeep Neve. Thank you for subscribing to my channel. See, in the earlier videos, we have already discussed about profit and loss ratios. Okay, so today we plan to discuss balance sheet ratios. Okay, let me just elaborate to you what precisely we mean by balance sheet ratios. See, any ratio will have one numerator and one denominator, right? So when you take both the values from the balance sheet itself, then it is called as which ratio? Balance sheet ratio. Correct, friends. Okay, so let's go ahead with our balance sheet ratios. The very first ratio is current ratio, and the formula for current ratio is current assets upon current liability. Okay, current assets upon what? Current liability. What it checks, it checks our ability to pay. To pay what? Current liabilities, correct, out of what? Current assets. How well we manage our working capital, this ratio talks about that. Okay, how good we are in paying our current liabilities out of our current assets. A question arises generally, sir, what if I pay my current liabilities out of fixed assets? Not a very good idea, friends. You can do that, but if you think deep on it, you would realize that you do it when generally it is the time to close your business, liquidation, right? I hope you remember what I'm talking. Realization account you prepare, you sell all the assets, and then from that money you start making payment of your liabilities, correct? So when you are a going concern, when you want to run your business in a sound state, what you should do is you should have enough current assets so that you can pay out your current liabilities. Okay, then what is the standard ratio? The standard ratio is 2 is to 1. Now, what does that mean? It means for every 1 rupee of current liability, we should have 2 rupees of what? Current assets. Okay, friends, for every 1 rupee of current liability, how much we should have? We should have 2 rupees of current assets. This becomes our current ratio. Then we talk about quick ratio, or also known as what? Acid test ratio. Now see what happens over here. When it is quick ratio, then the formula is current assets minus stock minus prepaid expenses divided by what? Current liabilities. Now, why we are deducting stock and prepaid expenses? See what happened in the earlier ratio, current ratio. We said we check our ability to pay our current liabilities out of what? Our current assets. Done. Let's say that you are a creditor of the company. You go to the shop or you go to the office of the company, and you ask for money. Okay, my money is due since long. Pay me my money. What the boss says, what man, you are asking for money all the time? Look at my stock, look at my debtors, look at my prepaid expenses. He'll say, see, sir, I have nothing to do with your quantum of stock, with your quantum of prepaid expenses. I'm more concerned that when will you pay me? You may be maintaining a very high current ratio, but the fact is that out of the current ratio, stock and prepaid expenses, they're typically called as what? Non-quick assets. What happens, guys? You can't quickly convert them into cash, right? So quick ratio is further stringent ratio. Current ratio is a general comparison that how well you maintain your current assets so that you can pay current liabilities out of it. But quick ratio is a little more stringent comparison. You keep aside stock, you keep aside prepaid expenses. See, your stock, you will take some time to get it converted into cash. And dear friends, understand prepaid expenses, you can never get them converted into cash. Then, sir, it is our current asset. Yeah, it is your asset, but you enjoy that asset. For example, you make a recharge in your mobile. You suppose you have a prepaid mobile, you make a recharge. Next day, you need that money. You make a call in the call center and tell them, sir, please give me my money back. What the person would say? He would say, sir, madam, please, we have given you all these facilities. Please enjoy the benefits for 30 days, 60 days, whatever recharge you have done. Will they give your money back? No. Same way, suppose you buy an insurance policy. 1 month has passed away. No contingencies have turned into real life tragic situations. Nothing has happened. You urge the insurance company, sir, please give me back my premium amount. Will they give back? They say, no, sir, not possible. We have covered you for all the 12 months, sir. You are protected in the event something happens, isn't it? So nobody gives you back your prepaid expenses. So that's why if I want to make a very strong comparison, what I will have to do from current assets, I remove stock, I remove prepaid expenses, then actually I come to know that how much current assets minus stock minus prepaid expense means how much quick assets I hold from which I can pay my current liabilities. Okay, here what happens is generally bank overdraft is treated as non-quick liability. Okay, friends. Now, one more ratio, more strict comparison. We have done current ratio, we have done quick ratio. Now, extension of this, we will do super quick ratio. Yeah. Now, you know what is going to happen? Now, in the denominator, you're right. In the denominator, we'll take current liability only. But in the numerator, I'll just take cash bank plus what? Plus marketable securities. What I can do with them, I can quickly convert them into cash. My ability to pay my current liabilities on the spot, cash bank balances plus those marketable securities, which can be what quickly converted into what cash. Okay. Then let's talk about one more ratio. Very nice ratio, I'll tell you. Stock working capital ratio. Let's see, guys. Stock working capital ratio. Now, see, there are two things. One, you should know the logic of the ratio. Second thing, sir, first tell us how to remember the ratio. Then we will get the logic, then we'll write in the exam. Fine. I'm absolutely in sync with you students. That's what I'm telling you. As a student, no, I really like this ratio. Why, first word is what? See, I'll tell you the hint for this. First word is what? Stock. Second word is what? Working capital. Take the first word in the numerator. That's simple. Okay. Take the second word in the denominator. Okay. Now you know what? Now make it further clear. I generally ask like this. Okay, when is the working capital? Okay, what is working capital? It is current assets minus what? Current liabilities, isn't it? When current assets and current liabilities are accurately measured in the balance sheet is prepared on the last day. Okay, then this stock is which stock? It is closing stock. Just a way to remember. First, you remember this stock working capital means in the numerator, the first word stock will come. In the denominator, the second word working capital will come. And working capital is current assets minus what? Current liabilities. When we prepare or when we get those current assets and current liabilities on the last day, in the current assets, what we include? We include closing stock. So the formula is this. Now the most important question arises, sir, what precisely this ratio shows? This ratio shows percentage of working capital blocked by who? Blocked by stock. Now, why this is a big concern? Guys, stock is what just now we discussed. It's a non-quick asset. Correct? Stock takes its own time to get converted into cash. It's a non-quick asset. So what should be the percentage of working capital that is blocked by stock? What is that? I have no answer for this. I mean to say that it varies from business to business. I would just say that this should be optimum as per industry. Now, why I'm giving you this kind of answer that I cannot tell you unless you tell me the type of industry. Very simple, guys. See, we will compare few businesses. Suppose a person is a milk vendor. I'm not even adding milk products, just milk vendor. We all know that milk is highly perishable, will he maintain any stock of it for 1 day, 2 day, 5 days, a month? No, sir, not possible. Morning he will bring the milk, by afternoon he'll sell it out. By afternoon he'll sell it off and go home, isn't it? So his stock would be infeasible, very small quantity, negligible quantity, isn't it? Now, if we talk about milk products like butter, cheese, and so on. Now, after refrigeration, they can be stored for a reasonably longer time, isn't it? There, what will happen? The stock would be kept inside the business, and there will be substantial stock. As you compare with milk and milk products, whose stock will be more? Definitely, milk product stock would be more, isn't it? Now you change the stream. Keep aside milk products. Let's come to a person selling furniture. It's a big mall, furniture mall, three-story mall. What happens, guys? Furniture has to be perishable or has to be durable? Sir, we'll buy perishable furniture, sir, but obviously it has to be durable. And then he has to keep a lot of stock on display so that people see that, people maybe compare what they want with what they get, and then they will decide whether to buy or not the facilities, the features of the furniture that you sell. So definitely what will happen there, the stock would be on a higher side. So that's why I told you guys it should be optimum. See, a furniture selling guy should compare his stock working capital ratio with that of his competitor. The another furniture selling guy, don't ask him to compare it with the one who's selling milk and milk products. Okay, that's why my answer is very standard that what you should do, it should be optimum. Okay, I hope this is clear. Then the next ratio that we discuss is debt equity ratio. Okay, once again, a very student friendly ratio. Okay, by now you must have understood what I'm trying to tell you. Tell me what will be the numerator, sir? Very right. First word will be the numerator, second word would be the denominator. Okay, friends, debt equity ratio. Debt means borrowed funds, equity means proprietor funds. Okay, here also there exists some standard 2 is to 1. But see, it doesn't mean that everybody has to follow this. Now, 2 is to 1 means what? Here it means for every 1 rupee of equity, company can borrow up to 2 rupees. This is a standard answer. But see, these are all thought processes. I can show you various companies. There are companies, guys, listed companies like Infosys. They do not believe in taking debt. They believe that let's use our own funds. That is zero or maybe negligible. Okay. Other companies like Reliance Industries, they believe, okay, let's take debt, let's take some liabilities, let's take risk, let's expand, let's grow, let's become big company. So it depends from person to person. So what you are trying to check that in your total capital employed, because we know debt plus equity is nothing but what? Capital employed. So what we are trying to check? We are trying to check that in our total capital employed, what is the composition of debt and that of what? Equity. Okay. Now the next ratio, capital gearing ratio. Okay. Now here the formula is what, it is debt plus reference capital upon equity shareholders funds. If we try to justify, guys, what is this? These are all items are funds with what? Fixed rate of returns. Yes, these are all funds with fixed rate of returns. And if we try to justify this, these are what? These are funds only, but what? With fluctuating or no fixed, we can say anything with fluctuating rate of returns. That is the difference. Okay, so more the ratio, the more dependence on debt and preference capital. Higher the ratio, higher is the dependence on what? Debt and preference capital. So the risk involved is high. See, suppose it happens like this: the debt plus preference capital is 10 lakh and equity capital is say 4 lakh. Means now how much is your capital gearing ratio? 2.5 times. The funds with fixed rate of returns are 2.5 times of the funds without fixed rate of returns. So the risk is more. Suppose there is some another company, it has something like this. Here it is 15 lakh and say this is 3 lakh. Now what? Now this is 5 times. What has happened, guys? The risk is more. You understand capital gear. You understand in the vehicle, right? Higher gear, higher speed, more fun. But more fun welcomes what? Invites what? More risk. That's simple. Okay, you can put your business on a top gear. Okay, you can go on borrowing funds, invest, make more profits, but then the risk is also very high. What is the risk that is involved? Suppose tomorrow if the recession comes, suppose tomorrow if something government policy changes, suppose some unprecedented attack happens on the country and the markets crash, the demands go down, there is a depression in the economy, what happens? Your business is at risk. So what we can understand from this, for capital gearing ratio, higher the ratio, higher is the risk. See guys, now I have not told you not to go with a higher ratio or higher risk. It is up to the, see, we generally think like this. Okay, Sensor, what to do? Higher ratio means to avoid the business or not to avoid the business. See, guys, there are different type of investors in the market depending upon their age group, depending upon their income, depending upon their risk appetite. There are different types of investors in the market. Somebody has a lesser risk appetite, willing to take very less risk. Somebody has a medium risk appetite. Somebody has a very high risk appetite. Those who are willing to take high risk, correct? Accordingly, according to their each individual's risk appetite, people do invest. So, what our job is? Our job as a finance manager doing financial analysis is to tell people, see, guys, in this particular company, capital gearing ratio is high, means the risk is high. Now it is your decision whether to invest or not. Our task as finance managers to do what? It is just to tell them, guide them that which company has a higher risk, which company has a lower risk. Okay. One more ratio, that is proprietary ratio. Now, what I tell my students, remember it like this: PT. Okay, not that athlete person I'm talking about, the very famous PT Usha ma'am. I'm not talking about her, but yes, it helps you to remember PT. Now, why so? No, because I'm telling you, as a student, I like this ratio very much. Debt equity ratio, I cannot forget. First word debt, second word equity. As a student, I love this ratio. Stock working capital ratio. First word stock, second word working capital. Done. As a student, probably I don't like this ratio. You know why? Because proprietary ratio gives me no hint. So let's generate a hint. It is what? Proprietors funds upon total assets. Okay. So that's why it is PT. So proprietors funds upon what? Total assets. Okay, you can do into 100. Now what does this ratio shows? It shows what? Percentage of total assets financed from proprietor fund. We all know proprietor fund means what? Own funds. Okay. Now see what happens is higher the ratio, what will happen, guys? Means more usage of proprietors funds to finance your business, isn't it? Higher the ratio means what? More usage of proprietor fund to finance the business. What it indicates? It indicates long term stability and solvency. Because if you're borrowing less, you have to make repayment of lesser debts. You can be more stable. I'll tell you very simple example. See, uh, post this pandemic or during this pandemic, COVID effect, okay, many shops were shut. We all know that. Those at least who are having their own shops, they somehow managed to survive. Those who had rented shops, they found it very difficult to keep the show going and they had to shut their businesses. This is a general observation. Most of them, it happened like that. Some people managed because they had some savings to deal with it. But otherwise, see, those people who have their own offices, own furniture, fixtures, plant, machine, they find it comparatively easier to survive because they don't have to pay interest, they don't have to pay installment, and that is why it shows your long term stability. Okay, friends. So, how many total ratios we have done till now? Let's take a quick look. We have done how many ratios? Seven ratios. Let's recollect. First one, current ratio. Second one, quick ratio. Third one, super quick ratio. Fourth one, what is the fourth one? Stock working capital ratio. Fifth one, debt equity ratio. Sixth one, capital gearing ratio. Seventh one, proprietary ratio. Okay, so these are all seven ratios from the balance sheet ratios that we are supposed to remember. I hope this was helpful to all of you. Correct, people? So, what you are going to remember? How many total ratios in the balance sheet? Seven ratios. Okay, thank you.